We continue IUL month here. Last week, we talked about participation rates, spreads, and cap rates. This week, we're going to dive into all of the expenses that you might encounter inside of an IUL. The expenses are one of the biggest impacts on not just how much liquidity you have in the early years, but the overall performance of the policy can be greatly affected if it's not properly designed and you end up with very high expenses. The only way to make sure that you get a well-designed policy with low expenses is to understand what's happening inside of that. We're going to dive into that today. This is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
My name is Jane with Texas Millionaire Club.
And I'm Carlo Vaquera with NetWealth Finance.
We appreciate you joining us for this. I just love talking IULs. Education on these things is so important so that people understand what they're buying. And as with most things, there's nothing more important than understanding the underlying expenses and what it's going to cost you to own one of these products. Since it is life insurance, what is the number one expense that everybody expects to be part of this particular product?
Well, whether you're doing a permanent life insurance product like an IUL or whole life, or even term insurance, you're going to be paying a cost of insurance. And so whatever the product is, there is going to be a cost to get that death benefit. And there are various ways that this is calculated, but that is something that is going to be present in life insurance products. You're going to pay for some death benefit, and there is what's called a net amount at risk in an IUL or in these cash value policies. And that's really what it comes down to in terms of that cost of insurance, how much the insurance company is on the hook for to pay your death benefit.
Now, what type of insurance are we purchasing here?
Underlying, it's ART, Annual Renewable Term.
Yeah, Annual Renewable Term. The insurance company is going to charge you based on the risk that you're going to die that year. That's how Annual Renewable Term is priced. So if you buy one of these policies when you're young, it's going to start off very inexpensive. And actually stays pretty inexpensive for a long time because statistically speaking, people don't generally die until they get old. Once you get old, the cost of insurance is going to be relatively high in relation to what you had paid per thousand when you were younger.
Yes, and regardless of the IUL policy that you get, we are going to manage the expense of that annual renewable term. When we're young, we have cheap insurance. As we get older, we're going to have more costly insurance. So it is in our best interest at some point, likely when we're maybe in retirement and we stop funding, we are going to reduce the death benefit down to that guideline minimum. When we reduce down to that guideline minimum, we're paying for barely any life insurance, and that really minimizes that cost of insurance expense.
Let's just clarify. We're paying for a bare minimum in relation to the cash value that's built up inside of the policy. That's how that net amount at risk is determined. There's a multiplier. It's based on how much cash value is in the policy. You have to have a certain amount of net amount at risk for it to still be considered life insurance. Good point, and it's very important to remember to manage that risk in the future if you're concerned about the cost that you're paying for the actual death benefit. I think that covers cost of insurance pretty comprehensively. Let's move on to the next fee that everybody will have when they put money inside of a policy. What is the charge that you can expect just to get your money inside of a policy?
Well, there's a charge called premium load. All carriers will charge you this fee, which is vary between different carriers. Usually, you should expect somewhere 5% to 10%. Basically, what it does is for every single dollar you put into your policy as your premium, there's a 5% to 10% will be charged as the premium load, which can be significant.
Yeah, there's different names from different carriers. I've seen it called a premium charge. I've seen it called a load fee, but essentially, it's the cost for us to get money inside of the policy. It's a one-time charge assessed when you put it in there. And from there, essentially inside the IUL, your money can only go up based on market returns, and it only goes down based on the overall expenses that they're going to charge you each year thereafter.
One way that I like to think of it is that's my cost of buying that downside protection in an IUL. It is a charge that I'll have to put those funds in. And as James said, it is a one-time charge. So once those funds are in there, they can grow perpetually with that downside protection.
I love the framing of that you're buying that downside protection with that load fee. I've often talked to my clients about it as relating it to when I go and actually purchase stock. Inevitably, anytime I go and I buy a stock in the stock market, it drops almost immediately afterward. And the difference here being with when I buy the stock, I don't know if it's going to continue to keep going down. But in this, it's only going to drop that one time, and then it can only go up after that. But I like the framing that you put on that. You're buying your downside protection. As Jing said, a typical load fee ranges from 5 to 10%. There was one product that charges 4%. Actually, I think it still does. So I would put the range between 4 and 10% because of that one product. But outside of that one product, I don't know any other ones that charge lower than that. A typical load fee, though, is 5 to 10% among the majority of your products. There have been some that charge more than 10%. There also can be some circumstances where a carrier may charge you a smaller load fee, but then increase the cost if you put in over a certain amount of money. There's also some varying ranges where, depending on how your policy is designed, it might affect how the load fee is charged. Now, we're not going to get too much into the weeds on that one because it is varying among companies how they charge that load fee. Just know that most of them charge basically a set load fee. It's not too complicated. Next, there's one more fee. Well, there's more than that meet this criteria, but there's one more that we see charged on every single policy. And it's not a very big one, but it is there and it's good to know about.
So every policy is going to have administrative expenses, and each carrier might call these different things. It is one of the smallest expenses inside of a policy, it tends to be. So they have to pay their employees who are managing their offices, doing different things. Various expenses come with running a life insurance company. So this policy admin fee is what's covering those types of expenses.
And this fee is very similar to the bank charges. A lot of times when we go to the bank, they charge us the monthly fee, but they gave us options to waive it. But for this, sometimes I will just let client think about just the monthly charge you have to pay because your policy is administered by the carriers.
Yeah, I like to refer to it just as the documentation fee. They're going to do the paperwork to send you a bill or an annual statement each year. That's what you're paying for. Some carriers, they might send it to you each month, an actual statement. So the fees do get charged each month. The load fee is assessed anytime you put money into it. It's not broken up. All of the other fees that we have inside of these are charged monthly, and they come out of the policy monthly. Okay, next, this can end up being one of the most expensive fees on some policies, especially late in the policy's lifespan when the cash accumulation gets very large. Not all carriers charge this fee, so it's kind of a key aspect to know if there's a charge for it. Can they add it later on, or will they promise to never charge this type of fee? What type of fee am I talking about?
So some carriers will have an asset charge. This might be, you could compare this to an assets under management fee that a financial advisor might charge. It might be in the range of 1%. And again, this is not every single carrier. I prefer carriers and products that don't require an asset charge for the most part, but it is not something that is in every product. So just keep in mind, if the carrier and product that you have has an asset charge, it's going to be based on the cash value inside of that policy, and it'll be a percentage of that cash value.
I think the most egregious fee I've seen charged in this realm was about 1.25 or 1.3%. of the account value, which is really steep from a financial management standpoint. I don't mind it so much if it's a very low asset fee and it's temporary. Case in point, National Life Group has one that's 0.35%, and they only charge it for 25 years. Now, 25 years, I guess I shouldn't say only. 25 years is a long time, but this is a product that's otherwise very low expense in general. So if you buy that type of product and you're funding it at a very low level, the cash value isn't going to get so expensive that 0.35% is going to seem excessive in relation to the other fees inside of it that are otherwise fairly low. Whereas you might have another policy that has all of the normal charges of most IULs that are fairly high, and then also charge a high asset fee for that one. Those just don't compare to a policy that doesn't charge one of those fees.
Another thing worth to mention is we could do some proper design to reduce some of the charges, but not this one for the asset fee.
Yeah, it's basically not impacted based on policy design. There's no way to avoid it. If the company wants to charge an asset fee and you plan on growing a lot of money inside of it, expect to get charged accordingly. Okay, there's another fee that, depending on the policy design, you may or may not see any charges in this particular column. Although if you do see charges in this particular column, it could mean a lot of different things. What's the charge that I'm referring to?
Well, we're talking the rider charges. When we design the policy, we can add different riders. A lot of the riders actually will come with no additional cost, but there are a lot of riders will have added rider fees, especially depends on what kind of riders. For example, the long-term care rider, because it's a long-term care, we all know the medical cost is super high. So some of the rider charges can be pretty hefty.
Another thing that might be more common when we're thinking about designing for cash value is some kind of high early cash value or liquidity rider. And it tends to be, in my opinion, that these are not to the advantage of the consumer. For the case of cash value growth, if you absolutely need that early liquidity, it can make sense, but I would not prefer to use it if there is an option not to.
Let's spend an extra minute talking about these enhanced liquidity riders. I think it's very important because when we often talk about a properly designed policy, one of the key things to look for in a properly designed policy is high early cash value. But there's a way to kind of hide the expenses inside of a bad design policy by adding an enhanced liquidity rider that does away with surrender charges, and it shows a lot more liquidity early on inside these policies. The problem with that is,
well, it comes with a charge. That is an expensive thing that will impact your future value because they charge those fees during that surrender period because you're minimizing those surrender charges. In the long term, this is going to result in long-term cash growth that is lower than if you just properly design with minimized expenses the way that we do.
Now let's talk a concrete example on that just to really put a fine point on this. With one of the carriers that we like to use, if you add the enhanced liquidity rider and it's not a properly designed policy, it might give you access to an additional $40,000 or $50,000 or $60,000, but your cost each year for the next 12 years might be $3,000 or $4,000. All of that is kind of hidden because you see all this extra cash available in the policy for you to be able to borrow. But if we were to properly design that policy, your liquidity is going to be very close to what it would be with the poor design and adding the enhanced liquidity rider without having to add the liquidity rider. Now, the savings on that comes from us reducing our commission by doing a blended design that we often talk about. You can still add an enhanced liquidity rider to the designs that we do, in which case you get access to a few thousand more dollars and the cost ends up being a few $100. Now that's a few $100 over the course of 12 years. So while you might get access to $3,000 or $4,000 extra dollars in that first year, it's going to cost you a little over $3,000 or $4,000 over the next 12 years, 3 or 4,000 in total. So it's kind of a wash, and it's not really worth it unless, like Carlos said, you need that cash value liquidity in that first year. If you absolutely have to have it, it can be worthwhile to pay for that enhanced liquidity rider. But with the clients that I've worked with over the last 7 or 8 years, I think I can only think of one that it made sense to add that enhanced liquidity rider to, because most people just don't need access to that tiny little bit at the very top when we already have access with a proper design to like 90% plus of our cash value.
I want to highlight that too, because where it impacts most, and there's various agents out there that will design with the high expense designs, and using this rider makes a huge difference in those. And that's the challenge. You got to find the proper design. It doesn't make a huge difference. And like James said, very few have absolutely needed that. But that is something to watch out for, is when people use these liquidity enhancements to hide that they're charging or it is an expensive policy.
Okay, let's consider that one wrapped up. One of the other major rider charges that we see, especially us, is because in a special design policy like we do, in order to actually reduce the overall expenses inside of a policy, we're going to do a blended design. That blend utilizes a supplemental term rider. And so we're going to end up seeing that cost of insurance for that supplemental term fall in the rider charges column.
So with that blend of that term, we are going to have that term show up in that rider charge. And that is really helping to minimize one of the big expenses in those early years. And that's that expense charge that's tied to that commission that's paid out on that base policy. And that's one of those things that you can't completely eliminate, but by using that term blend that we do, it really minimizes that in those early years.
That's a great segue into the next expense that we wanted to talk about, which was the expense charge. It's often called different things among different carriers, but what it boils down to, each carrier is going to recoup the cost that they put out to sell you that policy. That's going to include commissions paid to the insurance agent and anybody else at their organization, underwriting costs, cost of ordering medical records, medical exam, anything that factors in to the insurance company cost to sell you that policy. That can be the most expensive part of the policy. And so they don't charge you all of that up front. They don't charge you in year one. They're going to spread that out over a number of years. Typically, 10 to 12 years or 10 to 15 years is oftentimes what we'll see the insurance company recoup that over. That's why there's surrender charges tied to these policies, or I should say potential surrender charges. They're going to withhold a certain amount of cash value because they need to recoup those costs. As Carlo mentioned, we do the blended design because it minimizes that expense charge column.
To put some numbers to this, with poorly designed policies that we see all the time, you might see $4,000 a year for 10 to 15 years in that policy. So when we do these blends, in a properly designed blend that we do, that charge might be something like $500 a year. So it is a drastic difference. We're talking about 90% possible reduction in those expenses sometimes, depending on what the situation is.
Now, here's the kicker for this. The insurance company doesn't know if they're going to be ordering medical records or doing a medical exam in any given policy application. So where's the savings coming from when we do a proper design on these policies? We're not able to reduce the cost from the medical exam or not doing a medical exam. Where's those savings coming from that they're not getting charged $4,000 a year, but they're only getting charged $500 a year in that expense charge column?
Well, with our proper design, although all of those savings are from our commission, we really want to design each policy the same as if we are purchasing a policy. We'll design it the same way when we design for our customers. As James said, a lot of the cost will be fixed costs, but the commission can be reduced if we do the proper design.
Yep, and that's where I said you might see as much as, it might not be quite as much as 90% reduced in the overall expenses, but it's close to it. Really, the commission can be reduced by about 90% when doing these proper designs.
I'll add, it will depend on the carrier. Some carriers allow a bigger blend than others, and that will affect how much we can actually reduce it by as a percentage. For example, one of our top carriers, we could do a 10-to-1 blended design, in which case we can bring those expenses down by 10 times as much with the proper design if you have a large amount of death benefit. Other carriers may give us a 3-to-1 blend or 4-to-1 blend, in which case we can knock that commission down by 25% or 33%. So there's only so much we can do. But then there's carriers that don't let us blend at all, in which case you're going to roll the dice and do a high expense design regardless if you really want that product. Okay, I think that gets us through all of the main expenses that people are going to find inside of their policy. But there are some other things that people need to know about that we might think about as expenses or fees inside of a policy that they may encounter. What is one of those other fees that people might want to be aware of?
Well, there's a fees associated when we pick up different index options, and there's also different bonus index options.
Yeah, depending on the carrier, they may offer certain enhancements or offer some extra index option that's only available with that extra fee. Good point.
And so, for example, in my own policy, one of the strategies in indexing options that I use is going to have a 1% asset charge associated with the funds that are allocated to that in order to get a 40% bonus. So that can be really advantageous in a strong year. And it has actually worked out really well for me in the past.
So those may be the types of fees that are worth it to pay sometimes, maybe not all the time, but it is discretionary and the client can choose whether to pay it or not by participating in that particular index or those particular bonus options. Okay, let's wrap up this discussion with something that's not really a fee, but it is a cost associated inside of a policy if somebody chooses to utilize the cash value in a tax advantageous way.
Well, if you really want to get access to the cash value, most of the time we don't suggest people to withdraw from the cash value. We suggest people take the loan. So your life insurance policy will be a collateral. There's an loan interest charge people should be aware of if you have a loan outstanding from the carrier. Most of the carrier will charge somewhere between 5% to 8%. This is something you really need to budget. We encourage people to pay that loan off every year. So you don't pay loan on top of the loan next year or over the years.
So just to clarify, we want to make sure that we're paying that interest each year in order for that not to be added on to the principal.
Yeah, essentially you're trying to avoid the compounding of the loan interest. One of the ways that I like to phrase it is I like to pay the interest each year. Well, I don't like to pay it. Nobody likes to pay it. But we pay it because it's painful, because we don't like it. And it reminds us that it's not free money that we're borrowing. It also makes sure that it doesn't compound, but the growth inside of the policy can continue to compound. So good points, you guys. I think that wraps it up for the expenses inside of these policies. If you know of any that we've missed, or if you have any questions about new expenses that might pop up on new products, you can let us know in the comment section below. If you're watching this on YouTube, or you can reach out to us at our Substack or on our website and let us know about a particular expense that we might have missed. We're always interested in hearing from you guys. With that said, do you guys have a call to action for our listeners this week?
It's time for this week's call to action.
A good call to action will be think about with all those charges, why we still doing this IBC policy, this IUL policy, in comparison to, for example, a real estate investment. You put all your money into that real estate investment, you have all kinds of expenses as well. So for this purpose, I want all the audience to really think about all the expenses. Don't be afraid of putting your money into IUL policies.
In connection with that, if you have any questions about expenses, one of the best ways to understand the expenses is to sit down, look at an illustration, and walk through the expenses. That's one of the things that I like to do. If somebody is curious about understanding all of them, we can take a look at what the actual expenses would be in an illustration for a given person's situation. So get in touch with us, book a meeting. We'd love to help you understand these expenses for your situation.
Great advice. I would just say that it's important for people to know when you do get an illustration for an IUL, there is a report that will reveal all of these charges inside of that IUL, but not every illustration is required to do it. So the call to action from me is to make sure when you get an illustration, whoever is designing that illustration for you, tell them you want a policy charges ledger so that you can see the expenses inside of it and you don't have to try to guess. Now, this is our last episode in November, which we were deeming IUL month. But we have one more topic that we want to discuss about IUL. So we're going to creep into December with our next topic, which is volatility controlled indexes. They are widely available and spreading across the IUL space. And I think it's really important for our listeners to know more about volatility control indexes. So we will talk about that next week. And then December becomes whole life insurance month. I'm excited about this. Can't wait to see you in the next episode. I'm James Barber, your Oregon Cash Flow Pro. I'm licensed for life insurance and annuities across the country.
My name's Jane with Texas and Millionaire Club. You can join our free school community. I'm also licensed in multiple states. Happy to connect with you.
And I'm Carlo Vaquera. You can find me at netwealthfinance.com or on YouTube at netwealthfinance. We'll also work with life insurance clients across the country.
We'll see you then. The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.